The 1997 Asian financial crisis marked a significant turning point for many East and Southeast Asian economies, beginning in Thailand and reverberating across the region. This crisis was rooted in an intricate web of economic dependencies, mismanagement, and external shocks. At its core was an over-reliance on short-term foreign debt. Nations like Thailand and Indonesia borrowed aggressively from international markets to fuel rapid economic development, creating an illusion of stability. While initial investment surged, the need for quick repayment made these economies fragile, prone to swift changes in investor confidence. Compounding these vulnerabilities was the practice of pegging currencies at fixed rates to the US dollar. This strategy, while promoting initial economic stability, soon backfired as the dollar appreciated. Consequently, exports lost competitiveness, leading to ballooning trade deficits. As the burden of unfavorably high exchange rates mounted, the unsustainable nature of these fixed rates became apparent, triggering fears of an impending crisis. Resistance from confronting these stark realities only added to the economic strain, creating a perfect storm for financial upheaval. Another critical factor was the weak financial systems prevailing in these nations, characterized by a lack of regulatory oversight. Financial institutions often bypassed prudent lending practices, resulting in enormous debts that threatened to topple economies. Speculative investments in real estate drove prices up, leading to unsustainable asset bubbles. When growth started to falter, the impact of these poor practices became inevitable, sending shockwaves through the financial systems and encouraging capital flight as investors grew wary. As panic set in, the contagion effect took hold. The swift collapse of Thailand's baht instigated systemic risk across other nations, triggering a cascade of withdrawals from regional currencies and assets. This rapid spread of investor fear, reminiscent of a wildfire, engulfed countries like South Korea and Malaysia, deepening the crisis and complicating recovery efforts. With the International Monetary Fund stepping in to stabilize the situation through bailout packages, harsh austerity measures were imposed, leading to significant economic hardship for millions. In summary, the 1997 Asian financial crisis was a multifaceted disaster, fueled by complex interdependencies among economies, flawed policies, and social repercussions. The lessons learned from this crisis emphasize the critical importance of robust financial regulations and diversified debt structures to safeguard against future economic turmoil. Understanding these lessons is essential not only for Asian nations, but for global economies currently navigating similar pressures.